So you think just one day you're gonna wake up and be a millionaire, right? You're gonna suddenly turn around, look at your bank account, and find millions of dollars just magically appearing. Guess what? It can happen. And all it takes is about $10,000 a year and a little patience. But here's the part that nobody tells you. Wealth doesn't just happen overnight. It's not lottery tickets, it's not YOLO meme stocks, it's not even being the smartest person in the room. It's through investing, being consistent, using the right strategy, and it's you grinding through the first milestone that matters most, your first $100,000. Because once you hit 100K, everything changes. After that, your net worth doesn't just grow anymore, it literally explodes, and it starts taking off like a rocket. For 20 years, I worked on Wall Street, trading hundreds of billions of dollars of stock and advising some of the best, sharpest money managers and traders on the planet. I retired as a managing director, and now I'm going to break down how to become a millionaire, and I'll use real numbers and examples to show you how easy it really is. In this video, I'll show you why hitting 100K is the tipping point, where compound interest starts to really take over, what costs actually destroy your wealth, and here's a hint, it's not your iced Americano or your avocado toast. I'll tell you how to invest smarter, even if you're starting from scratch. And most importantly, how 100K can become $1 million faster than you think. So let's cut through the BS and get to work. The power of compound interest. It's a snowball effect. Albert Einstein called compound interest the eighth wonder of the world. And Warren Buffett's right-hand man, Charlie Munger, called the first 100K a bitch. But what makes it so powerful? Well, it's simple. The money you invest earns interest. And then your interest earns interest. Think of it like a snowball rolling down a hill. It starts small but grows rapidly as it accumulates more snow. For the snowball, the conduit of growth is gravity. For your money, it's all about the inertia of compounding interest. So let's break it down with an 8% return. I know over the past 30 years, the S&P has returned an average yearly nominal return of around 10%. But adjusted for inflation, the real return is roughly 8%. So for the sake of this video, we're just gonna go with 8. Now, if you want to hit 100K as fast as possible, you need to invest consistently and strategically. To put that plainly, you need to invest every month. And I'm going to show you why looking at two scenarios. Scenario 1, you invest $10,000 once at 8% and then just walk away. In scenario 2, you invest $10,000 initially plus $834 a month, which is an additional $10,000 per year. So here's where they differ. In scenario 1, you're getting that compounding interest at 8% a year on just your initial $10,000 investment. Your money doubles at year 9, but you only get to 100K in year 29. This is why the first 100K is the hardest. That's nearly 3 decades away, and that's way too long. You need to be adding to your investment on a consistent basis, which is what we have in scenario 2. Where we're going to see a beautiful, magical, accelerated growth trajectory. Between years 6 and 7, you hit that magical 100K level, and look at the acceleration that happens after you hit it. What took you nearly 7 years to get to that initial 100K, now has taken only 4 more years to double to 200K. At year 15, another crazy thing happens. Your total contributions are about $160,000, and the amount you have from compounding interest is $323,000. That's crazy. It's double the amount that you've actually put in. And by year 20, you have just over $500,000 at $543,937. And 7 years after that, you hit your first $1 million in net worth. And then around year 30, you make your first million net of total contributions at $1.3 million versus total contributions at around $310,000. Isn't that amazing? And honestly, the best is yet to come, because at year 45, you've invested $460,000 and your net worth is $4.8 million. Now that's a 10x investment return. This is what it's all about. This is the magic of compounding interest and why it's so important to continually add to your initial investment. Each year, the dollar amount of your gains increase, not only because you're adding more money, but because the money you've already earned is working for you as well, earning interest. Now, this is what they mean when they say it takes money to make money, and they're not wrong. So this is what you need to do. You need to invest a portion of your paycheck every month. Now, when you invest an additional $10,000 per year, whatever you can afford, you don't have to just do it in one lump sum. Break that 10K up into 12 equal payments of about $834 a month. This lets you capture market dips and smooth out that volatility. Yes, I know putting it all in at once is a higher percentage of greater returns, but before you decide what you're going to do, watch my video on dollar cost averaging versus lump sum investing to give you a better idea of what method may be best for you. Now here's something no one tells you. Invest at the beginning of the month. not the end. Why? Because of window dressing, which is a market phenomenon where fund managers adjust their portfolios going into month end, temporarily boosting stock prices. Now, the reason they do this is simple. They don't want to go on a month end, quarter end, a year end, sell their holdings down to make their positions look that they're losing money. They want to prop them up. They want to make them look better. It's basically lipstick on a pig, but everybody does it and no one sells into month end. Okay. So your average daily return, if you invest in the first 3 to 5 trading days of a month, is about 8.4 bips or 0.084%, compared with just 1.9 bips or 0.019% for the remainder of the month. The difference of that amounts to more than 4 times a high return. And adding to that, statistically, investing on the first trading day of the month tends to be one of the best single days for returns. Now, there's big expenses that matter more than coffee, okay? A lot of financial gurus say cut out the lattes and the avocado toast to save money. But let's be real, that's not what's keeping you from building wealth. Instead, focus on the big ticket items, like your car. New cars lose 20 to 30% of value the second you drive them off the lot. Instead of buying new, get a used car with the depreciation already baked in. Do some research on what cars have better resale values as well. I'll give you a hint from personal experience. It's not electric vehicles. The depreciation itself should make this absolutely prohibitive. I bought a 2021 Tesla Model 3 Performance Edition and I sold it 3 years later in perfect condition with only 14,000 kilometers on it and lost 60%. So buyer beware. The other one's your home. If you don't have kids, there's no need to live in a pricey area with high property taxes for better schools. Pick a location that fits your financial goals. It works for you, it works for your commute, and it's not someone else's expectations. Screw the Joneses. Lifestyle inflation. The more you earn, the more tempting it is to upgrade your lifestyle. Instead of spending more, invest the difference. Believe me, it got me too. One time early in my career, I bought a $4,000 house cat. That same year, I bought a $35,000 Italian motorcycle. Both were pretty sick, I'll be honest, but both weren't needed. Whenever I hang out with 100 millionaires, billionaires, or just massively wealthy people, they aren't wearing Pateks or Richard Mille watches. They have an Apple Watch on, and they're wearing no brand name clothes. Most of these people flashing their shit on socials are just faking jacks. Their whole businesses that cater to people that just rent fake private jets, cars, mansions, just to give the impression of wealth. Avoid that shit and stay in your lane and be comfortable in your own skin while you pass those fools at the turn. By making smart decisions on major purchases, you'll have more money to invest, which is how you get to 100K faster. Remember, that's the goal. It's a marathon, not a sprint. And honestly, diversify your investments. Don't just invest in stocks, bonds, or commodities. Consider real estate. Many financial pundits only talk about stocks, or bonds, or other type of financial assets, but I can tell you firsthand, real estate is a game changer. It's a hedge against inflation. You earn rental income while your property appreciates. This is making money while you sleep. It grows tax-free through asset appreciation as well as getting depreciation benefits. If it's an investment property, you can write off trips to go see the property if it's not in the same state. You need a new fridge, driveway, or roof? You don't need to worry. You can write off part of those costs against your investment income. Be aware you do have to pay property taxes every year and are subject to capital gains taxes too if you sell it. So make sure you ask these types of questions to your own accountant. Understanding your risks, okay? Stocks aren't guaranteed to go up. Yes, the market should continue to trend upwards over time, but in any given year, you could get a negative return. That 8%, that's just a target. It's not a given, and it's not a zero risk game. Though unlikely, you could lose all your money, but that's why diversification is key. Having a mix of stocks, cash, and a high yield savings account. Commodities like gold, bonds, and real estate makes your portfolio even more resilient and able to properly weather these market fluctuations. Take advantage of free money like employer contributions. One of the easiest ways to accelerate your path to 100K is by maximizing your employer's 401k or 403b matching program. If your company matches contributions, that's free money. Don't leave it on the table. Max it out. If you can't max out your retirement plan, contribute at least enough to get the full match, or in the end, just invest as much as you can. Think of it in percentage terms, not dollar amounts, like I will invest 20% of my take home every month. Take control of your monthly expenses and typical outflow, keep a reserve and a bit of spending money, and reinvest the rest. You need to take advantage of tax-free growth. Your investments can compound without getting taxed, supercharging your long-term returns. So look at Roth IRAs, Roth 401ks, health savings account, typically called HSAs, and 529s for your kids' education. The cheat code here is people who maximize their 401k early on often reach that 100K milestone much faster than those who don't. Getting to your first 100K takes discipline, patience, and above all else, you have to start. Focus on the big expenses, not just the small daily costs. Maximize your free money like employer 401k contributions. Invest consistently and strategically. Invest monthly. Make it automatic. Consider investing at the start of each month for slightly better average returns. Diversify beyond just stocks. Real estate is a powerful tool for building long-term wealth. Now, once you hit that 100K, your money starts working harder for you, and that path to 500K, 1 million, and beyond becomes so much easier. Now, if you found this video helpful, hit that like button, subscribe, and share it with your friends and family who could use some help building their own financial freedom. And remember, kindness is the rent we pay on earth, so do something nice for someone. Thanks for watching. Now go build that future, and I'll see you in the next one.